So easy exam, huh? Took you a little while, maybe. Oh, I apologize for putting those ridiculous teacher notes. Who would ever use those notes? It's just what's in the book. Professors can't actually read. Maybe they don't want to read the book. That could be it. Yeah, but anyway. It's just an outline of the book, and you got the PowerPoints. I apologize. These are now the solution manufacturers. So when you go, you will actually find for each one of the chapters the answers to all the questions, including the multiple choices. So, so who emailed me? You did. The two of you did. And then I realized it, and I thought, well, I don't want to give it to a few people that are still doing the exam and not have given it to everybody. So I waited until to tell you that they're out there now. So okay, pretty tough. And I didn't put them in until yesterday morning, I think it was. Okay. So we are doing chapter 6, are we already? Another day, another chapter. What's the first chapter when one of you guys are going to do some stuff on this, whatever you decide to do? The 10th one? And you're on? That'll be fun. Mr. Brian. Okay, more theory game. More theory. Here we go. Yeah. Oh, yeah. You can keep the exams and just give me the 2 multiple choice sheets. They pass them all in this way. Yeah. Oh, no, they're not cumulative as we go, only the finals cumulative. No. I won't do that. That's okay. I'll just, no, for each exam, you'll just have 5 chapters is enough, whatever it is, 5 or 6 chapters. Each exam, you're going to have 5 or 6 chapters, and the final will be cumulative. Yes. So if you know everything from the exams, you should be fine for the final. And if you're really good on this final, you should be fine for the CPA exam. And you'll have worked. How many exams are there? 5 or 6? 5? That's probably 500 questions, and then the final's a couple hundred more. You know, you put that all together, or maybe 150 more. I don't know. I want to take a couple from each chapter, so it makes the final kind of long. But, I just want you guys to learn this stuff. You think you learn more if you have an exam that you have to study for? Or you learn more if you just study? Being human beings, exams. It's really true. If there were no CPA exam, you think you'd know about as much about accounting when you start your career as you're going to know because there is what human beings are like that way. It's something about us. We need to be forced to work a little bit. Even though we want to do a good job and we want to be professional, actually you'll get to the point where it's not about making money and it's not about passing the exam. It really is about just doing a good job. You'll get when you're out there working and you're expecting everybody's like that, they're not. You just get used to it and you keep doing it. And of course, indirectly, it's about making money. So, yeah, you get paid. Anyway, thank you for taking the time to do this, and I'm sorry it's such a pain to learn all this stuff. It is. So, everything else, I guess. Anyway, this is really an important chapter. Not that other ones aren't very important, but this sort of gives you the whole view in a few pages of what an audit is supposed to be and how it's supposed to work. Okay? So, looking at this stuff, what are we doing? What really is the purpose of audit anyway? We want to issue an opinion. We do the audit so we can issue an opinion. And why would anybody want to pay us to do that? Do the audit so that we could issue the opinion. Why do you want the opinion? It reduces what? Information risk. Yep, it reduces information risk. That's all we're about. So that people can be more confident when they're investing in markets, right? That's it. investing in companies, loaning money to the company, investing in the stock. So the purpose of an audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects in accordance with an applicable financial accounting framework, which is what for financial statements of companies, corporations. Yeah, really accepting chemicals. Yeah, so, but it might not be in other types of audits, okay? So we use a different applicable framework, yeah? Okay, so we are going to do this in every single environment, you guys. We are going to do this. Steps in developing audit objectives. Understand the objectives and responsibilities of the audit. Divide the financial statements into cycles. We take a cycle approach. What's a cycle? Payroll is a cycle. There's a payroll cycle. That's an example of one. Okay? There's sales cycle. There's payroll cycle. Right? There's production cycle if you're a manufacturer. There's purchasing, right? Cycle with inventory, right? Into cost of goods sold, you know, if you're a merchandiser. Everybody got the idea? So we try to separate the business into cycles. Really, it's all one big cycle. Right? Everything's interactive, but everything else, every cycle is interactive with every other one. But we separate them so it's more convenient to audit. And then what we'll be doing is it used to be you just get out at the balance sheet and you sort out at the income statement. Now it's all of it at once. So, you know, if you think about the sales cycle, for instance. What accounts are in the sales cycle? Give me some examples. Accounts receivable, cash. The cash is in everything. So yeah, cash is in it. It guides everything. But that's where we do a lot of the cash work. Is related to the sales cycle. Because it's debit, cash, credit, sales. Think of the journal entries, right? Debit accounts receivable, credit sales. So I heard somebody say accounts receivable, sales. Keep going. Sales returns and allowances. Bad debt expense. Therefore allowed for doubtful accounts. So we did sales, but sales revenue. Yeah.
Unearned revenue.
Maybe unearned revenue. Oh, yeah, because you could have receivables, you could have unearned revenue, we could have cash sales, right? And what did we leave out of there? Oh, sales discounts, I guess we left out. Could you get into freight? Yes. Could you get into sales commissions? Yes, although you might do the freight with the inventory. But maybe that's freight in, and then maybe freight out is with the sales. Wherever it's easier to do, you just make sure that you capture everything. So the cycles are kind of flexible. So we build cycles. So as we go through, we look at the cycles in this book. This is what the author likes to have the cycles. It's just fine, right? It's not generally accepted auditing standards or something. So when you go to work, the cycles will be set up all kinds of different ways now. And we didn't even talk about it in the cycles, really. Did you? They are, though. You know, you can tell they, does it make sense to do bad debt expense allowance without accounts at the same time? Yes. Does it make sense to do accounts receivable with those? Sales with those? Yes. Search is logic. Okay, anyway. So we divided the cycle. No management's assertions about financial statements. Okay, this is critical. The assertions are management's. They are asserting different things about the statements, right? Okay? They're asserting the financial statements fairly present the financial position of the company as a result of its operations and cash flows. Right? We're not. We're giving an opinion on that. They're making the assertions. Got the idea? So management has the assertions. Know the general audit objectives for classes of transactions, accounts, and disclosures. There are going to be tests of transactions we're going to do, and there is going to be substantive testing we do. The tests of transactions are, guess what? On transactions, right? And then there are going to be tests of the accounts, which are called substantive tests, because we are substantiating the ending balances, right? Okay, across all of it, we are going to know about and test internal controls. And the internal controls are going to be what's used to record the transactions. And when you add up all the debits and credits, all the transactions, guess what you get? The ending balances, which are the substantive balances we're testing. In some areas of the audit, you'll use more internal control. Rely heavier on internal controls and testing those, therefore. Obtaining and understanding, right? Documenting it, testing them, tested, a whole bunch of that stuff. Cash receipts testing, cash disbursements testing, you know, that's it. Payroll testing. Okay, you're testing how they do things, aren't you? Obtain understanding of it, and then develop an audit program, and to first obtain the understanding, and then you test it, and then you test it, and then you come to some sort of a conclusion. And what do you use that for? You use that to reduce the amount of transactions you test, right? Which is one type of testing, and to reduce your substantive testing. Now, further on, you can do more or less tests of details or tests of transactions, okay, and test accounts, you tend to do more tested transactions. On balance sheet accounts, you do more ending balances. How would you possibly audit what somebody's sales are? With a substantive test, you'd have to confirm what everybody bought from them. Nobody even remembers what they bought from them. They think you were crazy. But can you do a confirmation? That's asking what the balance is, right? Okay. You can do a confirmation on receivables, couldn't you? Or on cash. Why would you test transactions for receivables and cash? I test transactions, though, for sales. Okay? First, rely on internal controls over recording, then test some of the transactions, and then say, hey, sales are okay. I'm not going to do a substantive test of sales, for example. Okay? Everybody got it? And on receivables, obviously, you're going to do some test of transactions because when you do the credit side of sales, guess what the debit side is typically? Accounts receivables, you're doing some test of transactions. And that would also be internal controls over that, so you'd be doing test of controls on both balance sheet and income statement accounts. It's just a matter of where you put your emphasis. Is that something there you guys are out there working? They didn't talk about it that way, but it's what you did, wasn't it? Yeah. Okay. Anyway, almost all the substantive testing is on balance sheet balance. Almost all of it is. Not always, but almost all of it. No specific audit objectives for classes of transactions, accounts, and disclosures. So that's it. Who do the audit objectives belong to? I already said the assertions or management's assertions. Whose objectives? Ours. We're the one giving the audit opinion. Okay? So there are audit objectives. Got it? Audit. Good stuff. And then just getting the idea how this is set up. All right. Management is responsible for everything. They just are. It's their representations, not ours. Financial statements and internal controls are theirs. Sarbanes-Oxley, we don't run their company. Sarbanes-Oxley increases management's responsibility for the financial statements they actually have to sign. They are going to certify the quarterly and annual financial statements submitted to the SEC. It puts more teeth in it. Now, they were always responsible, you guys. Now they have to certify and sign. And you wouldn't believe the reaction when CEOs and CFOs realize they now have to sign. And my view would be, well, you're already signing a management representation letter for me saying that you're taking responsibility. What's so different? I signed this and it's published in their annual report. Right? It's different. Okay? So they have a lot more liability here. And they really, the biggest thing is they feel they have a lot more responsibility for those statements. They can't say, oh, well, you did the financial statements. I did. No. Stop it out. We're auditing. You're preparing. You know, think about this. For an SEC company, do they have people that know how to put together financial statements? Yes. You bet. They have CPAs working for them. People who used to work for big four firms. Right? They were managers, occasionally partners, a lot of times managers and seniors in a big four firm. You think they can do the financial statement for young brands over here? They don't need their auditors to do the financial statement. What's the auditor doing? An audit. Now, in a real small company, might you need your CPA, your external CPA to help you with the accounting? Yes. But if you got that environment, I think you should be doing a compilation or a review, right? Probably not an audit. You get big enough, you have to have an audit. They're real expensive. You should have probably people on your staff who could actually prepare statements, right? Because you want to be careful you're not auditing your own work. Everybody got the idea on this? Beating this stuff to death. Have you noticed already in this class they just say the same thing over and over and over? When you read the books, they say the same thing over and over and over. It's a really small set here of information, and they just pound on it, because somehow us human beings can't absorb it if they write it just briefly, right? And I don't think, this book and another one I like to use are relatively short for auditing textbooks. Usually I go for the longer books, huh? Jack Schrader and I had you guys do Kiso's intermediate book, huh? It's the Bible. It's a monster. It's a great big huge thing, isn't it? And most schools don't do that because it's just too much for you to learn. I go the opposite direction on it. Why read it even more times? But what I really want you to do is work CPA exam questions. You guys have figured that out now, huh? A number of you have told me, yeah, I found a used book. But you paid $40 for one? How old is it? Was it 40?
No, it was 75.
Oh, yours was 75? Who else got one? Somebody else bought one recently. A CPA review maybe. No? I know somebody else was. Okay, 75. $75 for a year-old one. It's only 1 year old. That's not a bad investment, it's all right. When you go to work, if you've already got it through your employer, great. You're using them. Right? They're great. Becker or whoever's. If you don't have that, get hold of it. Get hold of it. Get hold of it. So you can work lots of questions. There are enough in the book. Okay? Who was it? You found some out online. Who told me that? found some out online?
Yeah.
Yeah, and they had a bunch of them out there?
Yeah, there's some for like every chapter.
Okay, and it was for this book even?
I don't think the chapters were the same for this book, but it was like
Some
the
other
same
book.
concept.
Yeah, and they had, what, 30 questions for each one probably?
Some of them had like 15, some of them had like 100. It just depended on the
Yeah.
chapter.
So you can find stuff out there. You guys know how to do that. Maybe you haven't done this. Oh, by the way, you could probably look up the answers out there. It's horrible, right? They're probably out there. You could probably find the question and find the answer. And if you have time to do that instead of just knowing it and writing it down, there's really something wrong with you. So don't do that, of course. Yeah. The idea is just look at the time, start getting better and better and better at it. And that's why I'm doing the exams the way I am too. Because you just get better. Working on many of them, huh? You'll get, I know that, sort of. And at first you won't get them right. Am I correct about this? At first you get a whole bunch of them wrong, and then after you do it a few times, you start figuring out how they're asking it. You sort of finesse it, right? I don't mean finesse it like not know what you're doing. You can finesse it like you know the material, but you can't figure out what the hell their question's asking, right? Did you find some of them have 4 really good responses and some have 4 awful responses? I wasn't kidding, was I? Just let me write down the damn answer, right? But now you don't get to do that. Okay? Got to figure out which one you want to use. All right. I swore on video. Luckily, nobody's ever going to watch these. Okay, report of management, right? You knew about this. We already looked at it, right, guys? So they're keeping repeating, but that's okay. This is the management's report, and they're just making the point that management takes responsibility for the financial statements and their internal controls, don't they? Okay? So you can see here that the president, CEO signed, and the senior vice president, chief financial officer signed, huh? CFO. Under. All right, criminal penalties for anyone who knowingly falsely certifies the statements, both for management, right? The CEO and the CFO, and for the auditors, right, guys? Okay. So you bet. Knowingly falsely certifies. All right. So our objectives. What are we doing? We're going to obtain reasonable assurance about the financial statements, fair disclosure, and all reasonable respects, right, guys? And free from material misstatements. Okay. All right. And we are going to opine. We're going to give an opinion on the statements and applicable reporting framework, okay? And then there'll be the report, the financial statements, and communicate with the audit committee where we need to. That's tough. Okay, what are we looking for, guys? Only material misstatements. If there's something immaterial that's wrong in the financial statements, who cares? It's not our responsibility, right? Maybe if you run across something that's immaterial when you tell a client about it, you're working with their staff and you find some immaterial error, of course you'll tell them about it. Do they have to book it for you to do financial statements or do an opinion on the financial statements? No. Right? So we'll have a bunch of past adjustments. We mentioned past adjustments before, right? I did. A whole list of all the journal entries that you proposed that were below your scope that are immaterial. Okay? They're all below your scope of materiality in particular areas of the audit. What do? Put them all on a list, right? Spreadsheet. And then what do? We add them all up and see what? The total impact on current assets, current liabilities, assets in total, liabilities in total, equity, revenues, expenses, particularly net income, of course. And if there's a material effect of them all grouped together, what? Book them all. Got it? And what are we really looking for? They all go in the same direction. That makes me very nervous in an audit. What do you think might have happened? They were intentional, and we're there. Right? You check on their statements. Okay? I told you about the selective search and principal statement, where somebody, you don't have enough income. You're the new controller or something, There's not enough income, go find it. So what do? You search for revenues. Will you find some? There's millions of transactions. Will you find some that weren't reported properly? Do I have that revenue? Sure. So you increase revenues. Then you go look at all the expenses, and what do you look for? Expenses that are too high. Will you find some? Sure. And what do? You reduce it. And what have you just done? Make your boss happy because you now have more net income. And falsified your financial statements, right? You didn't look for overstatements of revenue, and you didn't look for understatements of expenses. Very simple things, right? Okay? Be sure and watch for that sort of thing in you, but also watch for it in clients. What's going on? So it doesn't have to be intentional for things to be screwed up. I guess those are kind of an error, right? But it could be just errors in general, reporting things improperly. Okay, so you're responsible for material misstatements. You're giving reasonable assurance. Okay, professional skepticism. You don't quite trust anybody, you trust everybody, or you wouldn't be working with them. But, you know, you always maintain your professional skepticism. Maybe it's not quite true. This is a really good idea for your personal life, too. Don't just trust people. Check it out. Right? Check it out. I'm going to have lunch with a woman, several women. Why are women taking over everything? Oh, it's a nonprofit and wants to get it in. That's it. Okay, anyway, so there's a few people. Yeah. Actually, the meeting this morning was kind of refreshing. It was mostly guys. What are you going to find interesting? It's refreshing. Guys for a nonprofit, anyway. Usually it's all women. Anyway, this woman I'm going to have lunch with already checked me out. She wants to know whether or not I have integrity before she bothers to listen. But she's had enough. We don't. And the other woman I'm going with told me that. Said, I guess you checked out okay. She's willing to have lunch with you. Right? And she knows she checked me out because she checked her out before she bothered to have lunch with her too. She's busy. Right? It's a good idea. Before you accept a client, what do? Check out everything you possibly can. They seem like really nice people, right? You find out if they're a felon. Okay? You know, I know some felons who are really great. I have an uncle. He's passed away now. He went to the federal penitentiary for stealing cocaine and holding heroin. But he did. He did. He was a great guy. When my grandma was dying, he sat there with her. He was self-medicating at the time. I'm not kidding. He was. He was constantly high. But only a little bit high because he was taking care of grandma. I'm not kidding. And then when he died before her. Because he was self-medicating. Yeah. But anyway, he died before her. He died really young. He didn't live very long after that. She missed him so much. He'd stay up all night with her. What are you doing? Oh, he can stay up all night. You know. And after that, she had to actually go to bed. She felt lonely and miserable. Wow. He was a great guy who happened to deal drugs. Right? So don't just use, oh, I like them. That's, who cares if you like them. I have lots of people over the course of my lifetime that I really enjoyed drinking with who I would not have given any of my money. You know what I mean? They're really nice people. They're really fun. And they're maybe really irresponsible too. Right? So anyway, professional skepticism is really important. Errors versus fraud. One's a mistake, the other one's on purpose. Right? Fraudulent mistake. Okay? What's your scope for materiality? Fraud. You can't get that small. You're aware they're dishonest? Ugh. You might wonder about it if it's a real small amount, right? Real small misstatement or a real small theft. Why'd they bother? But fraud is fraud. Materiality scopes are almost zero, right? Extremely low. Okay, dishonest activity, illegal activity. What about errors? Well, now that's mistakes, right? Now it's got to be material, okay? Well, you don't know where it's always high. Big deal. You do some training, you help them learn, right? Okay, work with it. That's all right? Okay, fraudulent reporting versus theft of assets. Which costs companies more, shareholders more? Fraudulent reporting, by far. Bonuses, manipulating stock options, get the price of the stock up by fraudulent reporting, right? You get the price of the stock up, you get a big bonus, you get the stock up, you get to buy the stock cheap and sell it high, and it was all just fake. Who are you stealing from? All the shareholders, right? Wouldn't they far rather you sold $1,000 of cash than $100 million in stock value? Got the idea? Okay, so fraudulent reporting is far more expensive for stockholders. And we don't usually think of it that way, right? We send people to jail for embezzling. But stock fraud, probably not too bad. Occasionally they go. Okay? But not usually. Lots of people in jail for stealing $1,000, and not very many in jail for stealing $1 million. Weird. Okay, auditor's responsibility to consider laws and regulations. Okay, now we're not doing a fraud audit, unless we are. If you do some forensic auditing, now you are looking for frauds, right? Looking for illegal activity. If I am looking for illegal activity, how many transactions am I going to look at compared to, and I took on the responsibility of finding a fraud if there is one, right? How many transactions am I going to look at versus I'm just where I think they are not fraudulent, or I wouldn't have those clients. So here you're thinking of a fraud, right? That's why they're doing it. How big is, what's going to be the scope of the work? And the fraud audit, huge. I'm going to look at lots and lots of transactions until I find the fraud, right? What am I going to do if I'm doing a financial statement? I'm going to look at a few of them so that I can audit internal controls, right? So I can do tests of transactions, test the details, and so I can substantiate the analysis. I'm going to look at a representative sample because I don't think there's fraud there. If I think there's fraud, I'm going to go for it. So here's the deal. If the law and regulation has a direct effect on the financial statements, our responsibility is the same for errors and frauds. If it has an indirect effect on the statements or maybe no effect on the statements, I'm not giving any assurance about that at all. I'm not doing fraud on it. Got it? Okay, that's the point. Okay, laws and regulations. If you suspect that something is, laws are being broken, any laws, it doesn't have to just relate to financial statements, but they're, I don't know, they're paying bribes, foreign countries, breaking the law, whatever. Auditors, if you suspect it, you inquire of management, you ask them. You can, unless management's doing it, and then you need to go to the board, probably, directors, right? Audit committee, the board. Consult clients, counsel, or specialists, and we'll actually get representation letters from them too. They'll talk about every case that is pending up. They won't tell us much though. We'll talk about that later. And then consider accumulating more evidence. So if you suspect, if you know, you have to consider the effects on the financial statements, of course, would it be material? Consider the effect on the relationship with the client. Do I want to withdraw from the engagement? The CEO and the CFO are involved. Either one of them are both in the fraud. Maybe you don't want the client. Okay. Communicate with the audit committee or equivalent. Okay. So this audit committee is separate from the officers of the corporation. Right? They're totally independent. They're also independent from the rest of the board for this function. They hire the auditor, right? And the auditor works directly with them. So any information we give to them, we don't necessarily have to give it to the CFO and CEO, right? If it relates to the CFO and CEO, you wouldn't want to give it to them. So it's really good to have this audit committee, and then the audit committee represents, of course, the board of directors, committee of the board, and they represent, of course, all the stockholders, right, guys? Good. So you got an idea of how this thing works. Okay. And audit committees are required now. Okay. And they have insurance policies now that are pretty hefty because they have a lot of responsibility if something goes wrong. Okay. Of course, the company ends up paying for those too. All right, audits performed by dividing the statements into smaller segments or components. It just makes it easier. So we talked about that. Sales, cash receipts, acquisition of goods and services, cash disbursements, payroll maybe, allocation and adjustments, whatever. Okay, so we got a journal for the sales journal. You don't make a journal entry for every single sales transaction, right? They go to a sales journal, and then a sales journal is posted, right, in total. And then cash receipts, acquisition journal, cash receipts journal, payroll, general journal. And then, of course, we have all the ledgers, okay, going down to the financial statements, general ledger and subsidiary ledgers. You know what subsidiary ledger is? What is that? In the general ledger, you have an account called accounts receivable. Everybody aware of that? You might have 10,000 customers. For each one of your accounts receivable balances for the customers, we'll have a subsidiary record, which would be accounts receivable for that particular company. If you added all 10,000 of those together, and those are debits and credits to receivables too. Debit when they buy, right? Credit when they pay, right? On account. Okay, accounts receivable. If you totaled up all the debits and credits that go into subsidiary journals, and therefore the balance of all the subsidiary journals, they would total the general ledger balance. Does that make sense, guys? You're staying with me, right? Okay. It is so nice to teach people I had 211 because you learn to listen really good fast. You did, didn't you? It's good when you're at work, isn't it? You're welcome. When you talk as fast as they want, you get it. And when they're talking too fast and you don't get it, you tell them to stop and slow down. So you know what you're doing? Perfect. Exactly what we want out there. I used to get comments from partners with CPA firms. Geez, what the hell do you do with these kids? They're so humble and they work so hard. What's so different about Bellarmine? No mystery, is it? We just treat you guys like chef. This really works. So you go out there. I like it when students come back and they say, I've never worked for anybody as mean as you are. have that experience. My dad gave me that too. I was never surprised. Okay, anyway. So relationships, yeah, sure, all the cycles are related to each other. We said that. And notice cash is related to everything. Let's hope so. Although I don't know. If I could have my expenses and never pay for them, I'd love that. But I want the revenues collected from you. And of course, you have to pay the expenses, or guess what? Nobody will do business with you. So anyway, yeah, all these cycles really relate to each other, and all of them end up being in cash, of course. Okay, but we arbitrarily separated it. All right, gang. All right, so sure, accounts receivable, cash, sales return allowances, bad debt expense, and what we talked about. Sure, they're tied together. If you, by the way, when you're auditing something, do you know what the journal entries are that they did? Yes, because you know financial accounting. Remember, it's just a bunch of journal entries and they just added them all up, and that's what's in the balance sheet and income statement. So you're auditing that whole process, right? Just view it that way. That's what's happening. Okay? What would internal control do for you? Make sure they record things right. Record everything. Complete, right? Record it accurately. Right? Okay. Okay. Don't record anything that's not supposed to be there. Have internal controls for that. Okay, so here we go. 3 categories of management assertions. Assertions about classes of transactions, so types of transactions. Assertions about account balances at the end, and assertions about presentation disclosure. Because you have all the notes too, right? We're auditing the notes too, okay? And also presentation disclosure of the basic statements, I suppose. Okay, so here they are. Know these inside and out. Be able to write down a definition for them, okay? This is big. This is big all the way through. All these chapters, when you guys start doing them, for the most part, it's going to be doing this again and again and again and again. But slightly different in each case because guess what? Account receivable and account payable aren't the same thing, right? A sale and a purchase aren't the same thing. So it's a little different perspective on it, okay? So there's a little bit of difference in terms of how we approach auditing. Make sense? Not a big deal. Okay, occurrence, right? And a transaction might occur or not. If the transaction occurred, what do you want? You want to record the current period of the current period, right? So we could be testing for whether or not it occurred. Yeah. If it hasn't occurred yet, should they have recorded? Say it's revenue? No. Only when one expense is recorded that you don't have to be there. So if the transaction hasn't occurred, what do you think? It's a transaction or event, which is going to be shown where? On the income statement for the most part. Now, will the other side of it affect the balance sheet, of course? Yeah, it's debit cash or debit accounts receivable and credit sales, isn't it? But occurrence, we're usually talking about the balance sheet, okay? Or, I'm sorry, the income statement. Even though, of course, the other side goes to the other statement. Account balance, existence. Does it exist? Does the account receivable exist? Okay? So they're really kind of the same, aren't they? Right? Does the asset exist? We also do liability exist, but what do you think is probably more critical for a company that's trying to look as good as possible? A for-profit company who's trying to look profitable. I don't mean cheating, but they just want to look profitable. They want to be profitable, and then therefore look profitable. What might be the bias they might have? Overstating assets, understating liabilities, right? By the way, if it's a divorce proceeding, small company, divorce proceeding, that could flip-flop. Their assets could be as little as possible and their liabilities could be as much as possible. Because they're going to give half of it to the spouse they're divorcing. Right? Got the idea here? So you need to realize what kind of a world you're working in, of course. But usually, people want to look as good as possible in their financial statements and as poor as possible on their tax return, right? Save as much taxes as possible. Reflect as much income as possible. We're going to do both at once. Okay? Thank goodness for deferred income taxes, right? Okay, pull that off with good tax planning. Legally, right? You can do it. Okay, good tax planning. So existence, I'd worry about more on assets. What about completeness? I might worry about those more on what? Are they all there? Liabilities. What do you think? Might be more of a tendency for that. But you worry about both across all of the accounts, okay? All right? And for the transactions, also completeness. Are they all there? Accuracy, valuation, or allocation on the account balances. Allocation might be how much, let's say I make a market basket purchase of building plant. Plant is building. Building equipment, right? Maybe inventory. I purchase of that, which means that they want price, remember that intermediate, right? And you allocate the cost across it. There's an example of allocation. There's lots of times that we will allocate costs across. You can also allocate revenues, of course, and then valuation of it. It's still an accuracy issue, probably, I suppose. Okay? All right, and then classification, are they in the right account? Cutoffs, right, would be more related to revenues and expenses again, but to transactions in general. I want to make sure that all the transactions that happened this year are recorded this year. The ones from last year got recorded last year. The ones from next year get recorded next year. Anybody do any cutoff tests for inventory or anything? Yeah, that's what we're doing, huh? What do? A sample from the end of the year, right? And a sample from the beginning of the next. True. Of transactions. And you make sure they get recorded in the right period. That's it. Okay. So what do you want? If you're buying stuff, buying inventory, you kind of like to have the inventory recorded in the period you bought it. Not before, not after. Right? In the period you bought it. Or when you're selling things, same thing. The sale recorded properly. And the inventory updated properly. So that's what these cutoffs are about. So cutoff, they put it in this revenue and expense, but I think it really applies to account balances too, don't you? But it's not how we would audit the account balance. The way we'd audit it is for existence and completeness. Okay? All right? And then for liabilities, same thing. More liabilities over here. More revenue expense over there. Okay, and then rights and obligations, what's that? I have the right to an asset. By the way, there's some famous frauds where they took buildings and showed them the building, and they paid rent per day, right? Paid something to let it go in, right? And they go in and they pretend like the building is there, and they don't own it. The building existed. It might even be valued at an accurate number. It's just not your asset. You don't have the right to it. You got to make sure it's really theirs, right? So anybody look at any titles for property or actually go inspect any property? Maybe not a title. But yeah, they actually do that stuff. Okay? So anyway, an obligation, what would that be? It's my obligation. It's my debt. It's really mine. Okay? That's a liability. Okay? So, yeah. So it's kind of obvious. For presentation and disclosure, well, everything kind of wraps together then on these same stuff going across. But this is related to the notes, okay? And also to what's in terms of what disclosure is required of the face of the statement, or what disclosure is required of the notes, okay? By the way, what's the overriding what is the overriding criteria that we have for financial statements? Remember that? We want the financial statements to be what? Overriding principle is the right criteria. We want the information to be useful for decision making. Remember that stuff? These kind of relate to that. Okay? Well, kind of. They directly relate to that. Understandability, writing notes, even things on the face of the statement. Is understandability critical? And how do you have fair disclosure without understandability? So that's why it's big. Okay. All right, Public Company Accounting Oversight Board assertions, existence or occurrence, completeness, valuation, or allocation, rights and obligations, presentation, disclosure. Similar to the AICP auditing standards, as the first three assertions are applicable to balance of transactions, it's treated as a single assertion. It's the same stuff, isn't it? I like it better. It's simple. Trying to split them up almost. What were those three things, by the way? Test of transactions, test of balances, second test, and disclosures. Presentation disclosure. That's all they did, but they tried to split those. I don't know that it worked all that well. All right, gang. So what do these mean? I already kind of said it, but know this. Occurrences, recorded transactions actually existed. It occurred in this period. Occurrence was in this accounting period. Completeness, existing transactions are all recorded. Okay? Accuracy, recorded transactions are stated at the correct amount. Okay? Pretty obvious, huh? By the way, who do these objectives belong to? Wait a second. These things are what? Whose assertions? Management. And on the Public Company Accounting Oversight Board, there's still management's assertions, okay? These are all management's assertions. And then what are these things? This is ridiculous, I know. Does it seem like I really love teaching this class? I already told you the truth, right? This is crazy, isn't it? It's the same thing over and over. Even the words are simple. But this is really critical to know when you're out there auditing, isn't it? You didn't think about it. This is what you're doing. You're going to give people a piece of paper with the firm's signature on it, right? That the managing partner in the engagement is going to sign the firm's name and hand it to them. And they're going to charge them a whole bunch of money. And you can't tell them what you're doing. And then you're going to take responsibility for their financial statements, right? For your opinion on their financial statements. So this is really important stuff because we don't really give them anything, right? Sheet of paper. So we are going to collect evidence that what? We're going to document what their assertions are, and then we're going to, I can't believe that snow's not sticking at all. Kind of nice it's not. Pretty winter wonderland, and we don't have to drive on it. It'd be nice if we just stuck on trees and on the grass and stuff, but not sidewalks and streets. I think we could develop high-tech snow like that. Yeah, not going to anyway. Control the weather. So, we're going to document in the work papers what management's assertions were. We're going to document what our audit objectives are, which are related to them, of course, because our objectives are what? To make sure that their assertion was valid. That's all. Okay, so big deal. So when you say occurrence, we are going to do what? We're going to have an audit objective that makes sure that what? Recorded transactions exist. So on occurrence, on completeness, existing transactions are recorded. So occurrence is what? The ones that are recorded actually exist. What's completeness? All of them that exist are recorded. We got them all. Occurrence is that you don't have any that didn't, right? And completeness means that all of them that did have got recorded. It's too easy. Accuracy, recorded transactions are stated in the correct terms, of course. Okay. All right. Posting and summarization, transactions are included in the master files and are correctly summarized. This is just mechanical. And by the way, you think you might rely upon internal controls for this? Do you actually have a sales cycle where you record all of your sales at the correct amount at the right time, and they properly get posted into the sales journal, by the way, they don't always call it a sales journal. Call it anything you want. Different companies have different names for exactly the same thing. Senior auditors like to jerk you around by sending you to get a cash disbursements journal and have a client tell you we don't have a cash disbursements journal. Don't let them get away with it. Ask them where they record their checks. It's probably called a check record instead of a cash disbursements journal. You know, where they write all the checks, right? Record them all. Well, your client might not know what a cash disbursements journal and vice versa wouldn't know what a check register is. So just say, well, I'm looking for the journal where you do this. I bet you anything that every client you ever worked on does cash disbursements, whether they call it that or not. So don't let anybody suck you on that. Okay? Anybody, none of you guys had that experience yet? You had somebody do that to you? Oh, no, say I check your cash disbursements. Oh, you did check your cash disbursements. But they actually, the senior called it that, and they called it that in the work program, and the client called them that too. Oh, good. That's nice. That was too easy though. So I swear, I know this happens. I know some seniors will talk to the client and get them to call it only what they call it internally and not help them. Okay.
I had that happen to me. I don't remember what they asked me to ask them for.
Yeah, and you went to ask for it, and they didn't know what the hell you were talking about. Yeah.
And I
Would you
do
like
that
you're an
really.
idiot? Yeah. So would you go back to the senior and say they don't have it? That's what they want to have happen.
It was
They
April
can make
Fool.
fun of
It was or something.
Oh, no, it might have been just doing it. You might have gotten after something that doesn't exist. Yeah, that'd be good. Yeah, it could have been. Yeah, you don't know better.
Whatever it was really specific what it was, and it was kind of suspicious.
And the clients laughed at you. Yeah, they got you. Anyway, so posting and summarization is mechanical, but of course you want this to be right. Yeah? Classification, are they in the right accounts? Timing, transactions are recorded on the correct dates. And obviously that's pretty important. So the types of things that you would do. So here they are. This is for Hillsburg Hardware Company, the example they give you in the book. But, you know, here's management's assertion, here's our audit objective, and here's specific things we might do, okay? So this is in a sales transaction environment. Recorded sales are for shipments made to non-fictitious customers, okay? Well, you want to make sure they're a real customer. Okay, so transaction actually occurred during the period. But just, they're obvious. And by the way, imagine on the CPA exam or on my exam, could you do a little table like this? If I gave you an area of an audit, you know, one of the cycles, purchasing, payroll, you name it. Could you write down occurrence, completeness, accuracy, classification, cutoff, and then occurrence, completeness, accuracy, posting and summarization, classification, and timing. Timing is cutoff, right? You get a good cutoff, it's in the right period, timing. Okay, could you write these things down and then give me an example for any particular type of account? By the end of this class, yes. And you'd be in great shape when you do problems in the CPA exam. Okay? They'll ask you to write a little essay, and they'll ask you to write and they might say, write an audit program. And this is all they want. This is the beginning of an audit program, right? You'd have steps under the specific sales transaction related audit objectives. You'd have steps that you were going to do, okay, to make sure all these things are happening also under the general transaction. So, sure. Okay. So link them together. All right. General balance. We did them. Okay. We did them. Right? Okay. So let's add to this then. We mentioned cutoff is the copper period. Okay. Detailed timing. Account balances agree with master file amounts and with the general ledger. I told you what a subsidiary ledger is, right? For each one of our vendors, accounts payable. We got a total accounts payable and general ledger. For each one of the vendors, we have a subsidiary ledger account, right? With their balance. If you added up all the balances in the subsidiary ledger, will it total the balance in the general ledger? Yes, every single time. And you can do it for any accounts you want. Okay? Notes payable, notes receivable. Usually for receivables and payables. Can you do it for inventory? Sure, classes of inventory, and you keep track of them, yeah, add them all up. In fact, you do it for inventory in total. See if you're listing all your inventory items. If you add up how much you have of all the inventory items, the cost, what should it total to? The amount in the general ledger, of course, and we're going to make sure that's true. Okay? So even in that environment, okay? Don't call it a subsidiary ledger, your inventory is big deal. Okay? So make sure that the account balances agree with master file and with general ledger. So it ties into the general ledger. Absolutely. Okay. Well, realizable value, is that what we always use? Where do you use realizable value? Realizable value. Receivables. I heard you say it. Yeah. Receivables. Remember that? What do you do with receivables? You list the total amount that's owed to you, and then you list a allowance for doubtful accounts. And you subtract the allowance for doubtful accounts in your balance sheet. I hope it's obvious. Okay, you listed, no, I don't remember that. Okay, I got you. Okay, you list your allowance for doubtful accounts right below the receivables, or in parentheses or a note or something, and you take the difference, and that's your net accounts receivable. It's net realizable accounts receivable. So for accounts receivable, it's realizable. How about for land? This is sort of the cost. Unless you're an investment company, then it might be market value. Okay? Investments. Okay? Got the idea? How about available for sale securities? They're at market value, right? They're at market value. So, you know, whatever it is. Okay? So anyway, yeah. And then whatever the area is. That's a little bit of a glitch in the book. Okay. Rights and obligations. The asset must be owned. The liability is one you owe. It's your obligation. So rights relate to assets. Obligations relate to liabilities. Okay? So, for rights and obligations down here, the company has title to all inventory items listed. Inventories are not pledged as collateral, that sort of thing, or if they are, you disclose it properly. Valuation and allocation, inventory quantities of the client's physical records agree with items physically in hand. Prices used are materially correct. Extensions of price times quantity. So what they got is they get the count listed, right? And then they look up what the cost is. They take the cost times the count, and they get their extension. Anybody do inventory? And you got the total, and then you add them all up, and that's your total in the inventory account. You make your inventory adjustment. So yeah, all right. Classification, they're properly classified in this example, raw materials, work in process. So you can imagine in each area, each cycle, we're going to do this, huh? Okay, set this sort of thing up. All right. Purchase cutoff, you got it in the right year. Sales cutoff, you got it in the right year. Obviously, purchase is debit inventory. Sale is credit inventory. Debit, cost of goods sold. Right, guys? By the way, might you do the work on cost of goods sold at the same time as you do sales? Yeah. The internal control controls over recording cost of goods sold are related to the internal controls over recording sales. But those are two separate cycles, so you end up doing both of them at the same time. Okay. So detailed tie-in, realizable value, the total inventory item agrees with the general ledger, sure. Any inventories that are written down with realizable value compared, that's the realizable value aspect of inventories. I guess they were doing inventory only. Okay, anyway. So existence, completeness, all there is completeness. The only things listed that really exist, that are there, is existence. And they do exactly the same thing. Here's an example on notes payable. A lot of the disclosures on notes payable are in the notes to financial statements, right? So you worry more about disclosure here. Do you still worry about the balance on the face of the balance sheet? Of course. What's the big issue probably on notes payable? Existence or completeness? Rights or obligations? It's a liability, come on. It's an obligation. Obligations. This is too easy, isn't it? Okay? Makes sense. Okay? All right, anyway. So lots of footnote disclosure here, though, if you look at it, huh? Right? So all of them described in the footnotes are exist and are obligations of the company. So we've got rights, we got obligations rather, and existence. Okay. All required disclosures related to notes payable, including the financial statement footnotes. So we've got completeness in terms of disclosure too, right? Not just the dollar amount on the face of the statement. Footnote disclosures related to notes payable are accurate. Okay, good. Notes payable are properly classified. Short-term, long-term, be really obvious, huh? In current assets, current liabilities, receivables, payables. Okay. All right. So you must generally set the auditing standard. The auditor must obtain sufficient, appropriate audit evidence to support all management assertions in the financial statements. Everybody got it? How much is sufficient? Anybody got an answer for how much is sufficient? Come on. We did this already. I told you. Yeah. Your professional judgment. How much you think is enough? Sufficient is enough, right? How much, in your professional judgment, your firm, your audit, right? Audit team, sufficient. How much do you think is enough? What's appropriate? The right time. Yeah. Your professional judgment, you think you should use professional judgment. Okay. So you know what? Sufficient, sometimes you have to have more if the type you have is weaker evidence. Right? Sufficient might be a lot less if the type you have is really high quality evidence. How about if it's management representation? There's a lot higher. Right? Probably something you have to tell you like. How about if it's internally generated documents? Crummy, right? You're going to take and falsify those easy. Probably need to do a lot. How about if it's an outside confirmation? They think, okay, or from the customer. All of a sudden, that means so much, right? How come? Look at the audit evidence is higher quality, better quality. Independent third party, like that. Okay? So sufficient and appropriate go together, don't they? What type it is. Okay? Audit evidence. Evidence is what? Information that supports the representation of the financial statements, the balance of the balance sheet, income statement, cash flow statement, equity statement, and the disclosures in the notes to the financial statements, right? Evidence supporting a client's assertions, right? Our audit objectives are to make sure those assertions are correct. Okay. To support all management assertions in the statements. Audit process has 4 specific phases. Okay. Yeah.
What was appropriate again?
Appropriate is the type of evidence. Maybe you do a client representation. Maybe you look at internally sourced documents where they prepared it themselves. Maybe you look at documents that came from the outside to you. For instance, a sales invoice we did ourselves, right? A purchase invoice comes from our vendor and sends it to us. Which is better evidence? Purchase invoice, because it came from the outside. Checks. We write a check. It goes to the banking system. It goes to 2 banks. First, the bank, well, actually, it goes to our customer. to our vendor. It's an internally generated document. But then our vendor stamps it for deposit only or signs it either way, right? And then they put it in their bank. So now there's one outside person touched it, right? Then it goes to their bank. They touch it. Then it goes to our bank to clear, right? And then theoretically it comes back to us. It does things in the record, right? Okay? So you got the idea? We've got 3 outsiders touching that, and then we touched it twice. Very hard to do something fraudulent like that. Okay? Got the idea? Versus things that we just process inside of it. Okay? Got the idea? Yeah. So, but then on the other end of the spectrum, it might be something I observe myself, right? I watch them do something, a physical observation of the inventory. I did it. That's really good evidence because I did it, right? What if I examine a document? I did it. Okay. What if I make a computation myself for an estimate versus relying upon theirs? I did it. It's better estimate. I'm sorry, not better estimate. It is a better evidence. Okay. And then what if I do confirmations? Send a confirmation to the bank and they tell me how much is in the bank account. Really strong. Independent third party, right? Okay. So that answer your question? Pretty good. Is none of this new to you guys? You look like we're doing nothing new. That would mean that you read the chapter and paying attention. Fantastic. It's scary. You need to talk to my principals. They gave them a test. So guess what they did on the next chapter? Nothing. Of course not. Particularly if they did horrible on the test. They're going to be your employees. Well, they're going to be your company's employees. That was an interesting thing too. When I was working at a big 8 CPA firm, I thought everybody worked like that. You know, you get in this environment, you think the whole world is like that. And then I went into a company when I left. I was amazed. There are people who don't come to work consistently and seem to think they're going to keep their job. Unfortunately, they made me one of the bosses, so they didn't. I had a T-shirt. Did you about this one? I had a T-shirt that said Custer had it coming with a tomahawk on it. My boss bought it for me because I explained to them people who are not carrying their own weight should not work here. Well, yeah, but what do? You ask them to leave. God, we had a good team when we started doing that. At first, everybody was really nervous, but when they realized how hard I worked and how hard other managers were willing to work and how hard everybody we hired was willing to work, oh, by the way, we paid them a hell of a lot better, too. And the ones that didn't leave, which was most of them, I got them raises. So they started doing a lot more, right? So I think it's a good strategy for running businesses. I don't know about you guys. I think in successful companies, people work. So, but unfortunately, it's not always that way. Just like our students. Some do, some don't. 4 phases of a financial statement audit: plan and design the audit approach, perform tests of controls, a substantive test of transactions. The controls are first, because you need to do the controls to determine the level of substantive test you want. And by the way, and then there's perform analytical procedures and test the details and balances. Actually, while you're doing the substantive test of transactions, you might be doing the analytical procedures and the test of details and balances. What's an analytic? And then issue the audit, or complete the audit, issue an audit report. So all the chapters are going to be about getting to the point where you can do this, okay? Everything's about collecting evidence to support the report, okay? What's an analytic procedure, you think? That's a new one. I didn't talk about that. What's an analytic procedure? You guys ever calculate a ratio in your life? Yep, you know how to calculate ratios, right? That could be an analytical procedure. Say I'm going to do interest expense. I want to do interest expense. Well, you could do a lot of testing for interest expense if you want. Depends how material it is. You could recompute what all the interest expense should be on all of your debt, right? You could take every single loan that you've got that has interest on it. You can compute the interest, balance, average balance, times the interest rate, right? Okay, for the period of time. And then you look at what the journal entry is. Oh, and you could vouch all the journal entries, look at all the journal entries that have been recorded, and you could add it all up. I mean, you could do a whole lot of this, couldn't you? Okay? Well, what if they have pretty good internal controls over recording interest? You know that because you test the controls. Maybe I don't need to do all that work of coming up with the total amount of interest expense. Maybe what I could do instead is I could figure out what their average debt is, make an estimate of what their average interest rate is, take that average interest rate times the average debt and see if that number is fairly close to their interest expense on the income statement. And if it is, I could say, I'm done. How long would it take me to look at every single one of their notes and recompute the interest and add it all up and make sure it got recorded properly and all that stuff? How long would that take compared to figuring out what the average debt was, figuring out what the average interest rate is approximately, and doing one multiplication? Look at the number and say, hey, that's close. I'm done. Now, if the interest expense is extremely material, maybe I can't do that. But what if interest expense isn't extremely material? It's just one of their expenses. It'd be just fine. Analytical procedures are wonderful. They save you all kinds of time. And you use them if internal controls are weak. Probably not. Okay? A reason people ought to have good internal controls, one of them, is it reduces the work you have to do in the audit. Okay? So analytic procedures are just doing ratios, looking at relationships. You could look at cost of goods sold. If you had audited an inventory really heavily, beginning and ending balances, and then you know they have really good we have this situation. Okay. What does inventory become when you sell?
Cost of goods sold.
So we'll let it. Okay. What do we start with here? Nothing. Cost of goods sold, right? Okay. Last year you audited beginning inventory, right? Nice QB auditor. Last year we'll talk about what happens if you weren't. Much more expensive audit the first time you do it. Ending. I audited both of those, right? I audited this one last year. I audited this one this year. Do a whole lot of substantive work, substantiating that ending balance. Okay? And then I do tests and controls for purchases. Okay? This would be tests and controls. Why? Because the ending inventory is a relatively small amount compared to the purchases. I really want to rely on controls for the purchases. And I'll do tests of transactions because these are transactions. You know, debit inventory, credit accounts payable, those are transactions. Okay? Then what do I have over here? What's this? These are the cost of goods sold as I sell inventory, right? It comes out of here and it goes where? In here, of course, right? Could you do test and controls for that one too? Oh yeah, a lot of test and controls. That'd be great. If the controls are really good, I can draw an inference that they probably recorded it right. Particularly if this beginning inventory is right and ending inventory is right. But what else might I do if I'm really going to try not to beat up this number? I'm not going to work on that number. I want to audit that beginning balance and that ending balance of inventory, and I want to not do too much work on cost of goods sold. If I can rely on internal controls, what could I do? Give me a couple of measures of cost of goods sold ratios that would work for you.
Inventory turnover.
Yeah, inventory turnover is wonderful. How do you calculate inventory turnover?
Good. Cost of goods sold or sales over.
Cost of goods sold over, say, no, average inventory.
Is it inventory or sales?
Yeah, it's inventory turnover. You know what you said was inventory turnover? It's how big cost of goods sold is to the average inventory. So I've got the average inventory here, and you could get more sophisticated than beginning and ending, right? You could take monthly inventories or something. But you get your average inventory, right? And you divide it into cost of goods sold. Well, the cost of goods sold, they already recorded, right? You think the internal controls are good? So if you get a turnover here that is similar to last year, or if it's not similar to last year, you expected it to change because they changed the way they run their business or something, right? But you have an expectation of that turnover, and that turnover comes out pretty good. What do you think? Not bad, huh? And then if you've done all the receivables and the sales, and you feel pretty comfortable with those, what else could you do? Give me another one that relates to cost of goods sold, another good ratio. Sales, cost of goods sold, what?
Gross profit.
Yeah, gross profit percentage, absolutely. So these things are really valuable. This analytical procedures can save you a lot of time, right? This is more analytical procedures. Calculating that ratio, they're not all ratios, they're just relationships, looking at relationships, okay? Sales, less cost of goods sold is what? Gross profit. What if I have a normal percentage gross profit? What does that probably tell me if I trust the sales number? No, sales are the right number. Cost of goods sold, I don't know if it's the right number, but I calculate that I've got a normal gross profit percentage. What do you think? Cost of goods sold must be what? Pretty good. You got it, guys? So you're getting a feeling for what these things are. By the way, I don't care what we cover when. You knew that already, didn't you? I just escaped nothing. Okay, get rid of that. Okay, so anyway, we got a few more minutes. Don't start acting like you're leaving. Because then I'll leave early and I'll feel really guilty and stuff. I just talked to you about working hard, so this is the best I can do for working hard, by the way. There it is. Okay. All right, so anyway, yeah. So we got analytic procedures in there too. So what do we have now? Oh, by the way, analytic procedures are a type of test. Okay? It says perform analytic procedures and test of details of balances. That's substantive testing, looking at the balance. The analytic procedure is a quick and dirty way to estimate the balance. Does that make sense? Versus when you're performing test of controls and they put the test of transactions with that, testing the controls is you take a real small sample, you find out what their controls are, how you record sales, how do you record purchases, whatever it is, okay? You find out what the procedures are, and then you take a really small sample of transactions and run them all the way through the system. So if it's sales, you start with the customer calling in an order, maybe, or doing an order online or whatever, and you run all the way through to when that hits the financial statements, right? Got the idea? This is general ledger, and therefore it'll be in the financial statements. And you do a test of that for a small sample, but you go all the way through. You're testing, does their control work the way it was designed? So first you get an understanding of the controls, you develop an understanding, you document that understanding of the controls, you decide how much you're going to test those controls. If by design they're terrible, you don't test them much, but 4, right? But if they're really well designed, you test them to make sure they really are following those controls. Make sense? And now you can rely on the controls to reduce tests of transactions, which, you know what? You've already been doing tests of transactions when you tested those controls. You just do more, okay? All right? And you don't have to go all the way through the system. You can look at each piece that you want into of the system, right? Okay? So we do substantive tests of transactions. If these turn out really, really good, I might rely more on analytic procedures and less on substantive procedures for the ending balances, right? Okay, so here's an answer on the exams and on the CPA exam. Are analytic procedures used as testing controls? No, they cannot. They're testing an ending balance. Give me a break. Are substantive procedures testing controls? No, they're looking at ending balances. Are analytic procedures, though, substantive tests? Yes, they can be if you're substantiating an ending balance, estimating an ending balance. Got it? Okay, so get this stuff down. And I know it's really tough because you read this stuff and you listen to me bullshit about it. At least when I'm bullshitting about it, I don't say it the same way the author does, do I? Not even close. But we're saying the same thing. Okay? I'm just trying to make it a little more real. And I know you're reading that, and I know they're giving you the technical jargon and stuff. But I don't know about you, but it just kind of, you can read, huh? Like, what the hell are they talking about? How can I study this stuff? Turn it into something real. Try to relate to something that you've done. Okay? Oh, it's just debits and credits. It's just not a big deal. Okay. Anyway, yeah. So those will be questions. I guess you like that. Okay, come on. Was that it really? Is it really? Oh, it can't be. Gee, I'm not done with the time. Okay, did we skip anything? They're all going to say no. Let me out of here. Take a look. There's a little bit more detail on page 150, 151. You know, there's the general ledger, right? The adjusted trial balance, little tiny company. And then there's their cycles. I'd read through that. It tells you all the accounts of the balance sheet, the income statement. Look how many relate to acquisition and payment, for instance, right? Look how many relate to capital acquisition. You got the idea? So know basically what those accounts are. As we go through each one of the cycles throughout the book, we're going to look at them, right? So it's not like you have to memorize these or something. But just get an idea what might go into each particular cycle, okay? All right, and there's better descriptions over on page 155. Richard Schrader has written in his book here. It's like having Richard right here with us, isn't it? He has written it. He loaned me this book because I was going to teach it this one semester, remember? Yeah, now I'm stuck. One of you guys after this class, would you be willing to teach this forever for us? You ready? No? Okay, maybe not. All right, anyway. Maybe if you work for Get you in here. Okay, you got a master's degree and you worked for 5 years, that might be possible. Actually, I'm encouraging David Collins to try and hire somebody who is exactly like that. Maybe made the manager level in a big four CPA firm or a large CPA firm or something, that I've used before, of course, where they have really good experience and they'd like to teach and they make a really good living. So when we give them $3,000 to do a class for us, which is kind of what they pay adjuncts, something like that, you know, for a whole bunch of work, because the first time it's kind of work to do this. But if you want to later, anybody ever want to be a teacher? Really? What the hell's wrong with you? Why would anybody want to do this? Okay, anyway, yeah. That's right, you don't have to work. Okay, yeah. I never want to set foot on campus again as long as I live. People actually do. Anyway, these are nice descriptions on page 155, table 6.2. Read those too. They're more in depth once we have to. They're what I said, I hope. Okay, and then the transaction related ones are on page 158. The balance related ones are on page 161. I think we actually covered everything. What a short little simple chapter. See you guys. We'll move on next time. Keep working. Hang in there.